देना पहन के उसी को क्लास करते हैं। देना कहाँ रखी है?
ये तो उधर के लैपटॉप से
उधर
Okay, so good morning everybody and welcome to this session.
Morning, sir.
Good morning Minu ji.
Very good morning, sir.
Good morning Ankit ji. So
very good morning, sir.
Good morning, sir. Good morning, sir.
good morning. Right, sir. So we can start it now without any further formalities. अगर आप में से किसी के भी कोई भी डाउट्स हैं, so हम उसको स्टार्ट कर सकते हैं immediately.
Yes, sir. I have one doubt, sir.
आपके पास स्क्रीन शेयरिंग ऑप्शन आ रहा है क्या? आप में से किसी के पास? जस्ट चेक दैट.
Yes, sir.
तुम्हारा स्क्रीन शेयरिंग
No, sir.
नहीं आ रहा है?
नहीं, it is disabled.
Okay.
It's coming.
हो रहा है? किसी का स्क्रीन शेयर ऑप्शन आ रहा है सर? Anybody able to do it?
No, sir.
Only the host can share.
Only the host can share. Okay, ठीक है. अगर जरूरत पड़ेगी तो I'll make somebody host अगर किसी को भी स्क्रीन शेयर करनी होगी अपना कोई डाउट पूछने के लिए तो. So and then they can make me host again. This is how we can do it. Okay.
So Mahajan, I have a question.
Yes, please.
My name is Rajiv Sharma. I attended the course sometime in December last year, but for some reason I couldn't attend the, couldn't take the exam.
Okay. Okay.
So my only, I was preoccupied with some personal matters, so there has been long gap. So my question is at that time of undertaking the course, I was told that the syllabus is valid till 31st March.
Right.
And in the meanwhile, this lockdown happened. So what is the status, sir? The course is,
it has been changed. Some changes are there. Like Sale of Goods Act and Contract Act, they have removed number 1.
Mm-hmm.
Number 2, the case study part was earlier 16 marks. Now it has raised to 20 marks.
Okay.
And some new in-days are also introduced. Total 4 in-days are there now as the part of syllabus.
Okay.
And some minor changes are there in the mark reallocation of macroeconomics and some minor topics also.
Okay.
So major changes like Sale of Goods Act and Contract Act has been removed and the case study part has gone up to 20 marks
But
And
case study, there is no syllabus as such. So, one has to focus, say, instead of 2 case studies, maybe 3 or 4, whatever. Huh?
yes, 3 case studies will be there.
3 case studies. Huh?
Yes.
Okay. So I can still attempt with the old knowledge.
Yes, definitely. You
And
can
then
attempt the
and then
existing.
yeah, sure. Thank you so much.
Most welcome, sir. Most welcome.
Hello, sir.
Yeah.
I also had a couple of doubts. Can you explain more about the market valuation method and about option valuation and fixed income securities valuation?
Okay. Like this is really very broad because the option valuation technique, there are 2 major methods. One is the binomial pricing model and the other one is Black-Scholes option pricing model. And fixed income is, these 2 are whole chapters. Like fixed income is 3 hours chapter, option is also 3 hours chapter. So going through the entire thing is not feasible.
You're right.
If you can pinpoint any doubt that I attempted this part and I am not getting it, then it will be really better.
And actually, the thing is, I attempted a couple of times in the old syllabus, and the only part I couldn't solve was the fixed income securities.
Okay.
So I need a little help and maybe your guidance in.
Okay. So I'll let you know. Let's wait for a few more minutes and many other people will also join. So probably some of them will start asking specific doubts on fixed income that will serve your purpose also. And otherwise, towards the end of the session, we can discuss कि कैसे हम उसकी preparation further करें.
Right, sir. Thank you.
Yes, sir. I have one doubt, sir.
Yeah, please, Ankit ji.
Yeah, sir. In the sir, FCFF is equal to FCFE plus preference shares plus long-term debts plus short-term debts. Means broadly, when we add all these 4, it is equivalent to FCFF. Am I right, sir?
Right. So I will quickly give you one concept. Just a moment. I will open that.
Sir, I have a one query in this. Sir, if we have to calculate FCFE from the FCFF, then we have to, it means it is in the equation, we have to subtract from the FCFF minus preference minus long term minus short term. But sir, sometimes it is not matched to the logics.
I will tell you, sir. I will tell you. Now that's a nice question. So when I explained this concept FCFF and FCFE, I told that there are 2 circles. One is the circle for equity shareholders and the other one is the circle for the whole firm. I hope my screen sharing is visible to everybody, right?
Yes, sir.
Yes, sir. Yes, sir.
Okay, fantastic. Regarding the language of communication today, so whatever you wish, if it is English, Hindi, I'm comfortable with both. So if there are some people from South India, then we'll prefer to go with English only. And otherwise we can mix it as ever, whatever you wish. Right, sir. So this is for calculation of equity. This is circle number 1. For calculation of value of firm, this is circle number 2. So my rule of thumb is like this: take cash flow of people outside the circle only. So if you are calculating FCFF, it means circle number 2. Then any cash flow related to preference share, equity share, long-term debt and short-term debt should be ignored completely. But if you are talking value of equity, that is circle number 1, then again the rule is same. Take cash flow of people who are outside the circle, right? Who are outside the circle. Okay. Hardeep, you will have to share the question here again because I have posted this doubt session message to 13 odd groups. So आपको या तो group का नाम बताना पड़ेगा. So I'll take questions. Right.
Sir, in the ICSI third valuation group, sir.
Okay.
Online.
Third. So once I finish this query, then you can tell me and I will visit that group. Right. So I was telling you कि equity shareholders point of view, say if you want to make valuation, so preference share, short-term debt and long-term debt are outside the circle. What does it mean? If you start with FCFF and you want to arrive at FCFE, start with FCFF and want to arrive at FCFE. So difference between these 2 circles is of preference shares, long-term debt and short-term debt. तो अभी इन तीनों की वजह से जो भी कैश फ्लो अराइज होता है, those cash flows must be treated like interest paid on short term debt, interest paid on long term debt, dividend paid to preference shareholders. These three items should be deducted to arrive at FCFE. Similarly, repayment of short term debt, repayment of long term debt, redemption of preference share, this should be deducted from FCFF to arrive at FCFE. Any inflow like new short-term loan received or new long-term loan received or issue of preference share, these items are inflow. So FCFF plus issue of debenture, issue of short-term loan or issue of preference share should be added to arrive at FCFE. So difference between FCFF and FCFE is due to these three items: preference shares, long-term debt and short-term debt. तो FCFF से FCFE की तरफ जा रहे हैं, तो जो भी नेचुरल कैश फ्लो है उसको ट्रीट करेंगे. अगर आउटफ्लो है तो माइनस और इनफ्लो है तो प्लस. लेकिन अगर FCFE से FCFF की तरफ आ रहे हैं तो सब रिवर्स करना पड़ेगा. यानी कि इंटरेस्ट विल हैव टू बी एडेड बैक, रीपेमेंट हैज टू बी एडेड बैक, एंड सिमिलरली इशू ऑफ प्रेफरेंस शेयर और डिवेंचर से जो पैसा हमने इनफ्लो लिया था दैट विल हैव टू बी डिडक्टेड. तो अगर मैं क्विकली साथ में एक वर्ड फाइल पर आपको इस चीज को लिख करके बताऊं, जस्ट गिव मी वन मोमेंट एंड दिस इज, आई लॉस्ट द वर्ड फाइल. ओके, आई विल ओपन इट अगेन. वेट अ मोमेंट. सो हियर, okay. So now the thing is like this, the cash flow should look like this. If you want FCFE, that will be FCFF minus interest, पर वो भी 1 माइनस टैक्स करके लेना पड़ेगा क्योंकि आपको आफ्टर टैक्स इंटरेस्ट माइनस करना है, माइनस रीपेमेंट. अब ये रीपेमेंट चाहे शॉर्ट टर्म लोन का हो, लॉन्ग टर्म लोन का हो या फिर प्रेफरेंस शेयर्स का रिडम्पशन हो, प्लस इशू. अब अगेन ये इशू चाहे लॉन्ग टर्म डेट हो, शॉर्ट टर्म डेट लाइक कमर्शियल पेपर हो या फिर प्रेफरेंस शेयर्स हो, उसको हमको ऐड करना पड़ेगा. देन यू विल अराइव एट FCFE. FCFF के पर्पस से यही सारा कैलकुलेशन रिवर्स हो जाएगा. लाइक आई वांट टू अराइव एट FCFF starting from FCFE. So in that case it will become this, I will have to add, this I will have to add, and this I will have to deduct. Right, sir? I hope that serves the purpose. Now let's take
Yes, sir.
one doubt from ICSI Online 3. It has been posted, right? ICSI Online 3. Okay, I got it. Okay, you have posted as a personal message, right? Not on the group. Okay. So I'll prefer English. No issue, sir. No issue. That is what I was trying to know. Can you repose the doubt to me personally rather than on the group? Or if you can ask by voice or by chat, that is also welcome.
Sir, here in interest, what you taken this where is it only short term, na?
Both, sir. Short term and long term. Actually, there are two concepts. Yeah, that's the right point you have asked. Let me explain it again. So there are three circles, in fact, not two. I'll tell you. Look at this. So usually people say that firm means firm includes equity shares, preference shares, long-term loan and short-term loan all, right? But some people can also say that the definition of firm is like this. I'm sorry. Definition of firm includes only equity shares, preference shares and long-term loan. And if you want to exclude short-term loan from the definition of the firm, in that particular situation, in this situation, short-term debt will be outside the firm and their cash flow would have been already treated So between FCF and FCFF and FCFE, only long-term debt will be treated. So what should be the correct definition? Should I include short-term debt in the definition of firm, or should I exclude it from the definition of firm? That is, should I follow the red circle or should I follow the green circle? That is the question. So nowadays, this one is more popular, sir. That is, you include short-term debt also as part of it, but this one is also not wrong. So for examination purpose, you can follow this, that short-term debt is also part of the firm. And that's why the formula I have written over here, it includes interest on both long-term and short-term debt. Similarly, repayment of both short-term and long-term loan. Similarly, issue of both long-term and short-term debt.
Thank you, sir. So I have posted some queries on that one.
Okay. On the chat window, na?
Yeah.
I request everybody to post your queries on chat window so that we will follow that sequence to answer, and you will have a certainty that when your question will be answered. Okay, okay. This is the query. MI Corporation is a PE ratio of 7 times. I hope query is visible to everybody, right? Because it has been posted to everyone. So you can read it simultaneously with me. Just a second.
Actually, I posted it privately to you. If you would like, I can.
Yeah, better to post it to everyone so that when I read the question, everyone can read and take advantage of it.
I think it's posted to everyone. We can view it.
MI Corporation, na? Right. MI Corporation has a PE ratio of 7 times, and okay, I'll copy and paste it. Na? I think it will allow me to copy. MI Corporation has PE ratio of 7 and it is lesser than 30% from the industry average. It acquires business and its profits are mainly from acquiring other companies. The analyst has found before acquiring other companies, MI Corporation influenced target companies to inflate their income expenses in their financial reporting. Influenced target companies to inflate their income. Okay. After acquisition, MI Corporation resumed to normal reporting. The return on asset is 10% on invested capital. What is the current market price of the share? So this question looks like that somebody has given from his memory. It might have been asked and somebody has given this question from memory because the question appears to be incomplete. Current market price we cannot calculate because earning of the company is not given. But definitely the value determined in the pre-money valuation is they are accelerating income. Na? Influence target companies to inflate their income. So question is incomplete because okay, if I create a question something like this, so before acquisition of the company, if you tell the company that you accelerate your booking of expenses, and after acquisition of the company, if you pressurize them to accelerate their booking of the income, that is revenue recognition, then your pre-money valuation will have a downward bias and your post-money valuation will have an upward bias. Before acquiring a company, you are saying expedite payments, book all expenses right now, so that company will look cheaper. Once you acquire their business, then you expedite booking of income, that is revenue recognition. So that will make downward bias before acquisition and upward bias after acquisition. That's the answer, sir. Right, sir?
Sir, please repeat once again.
Okay. So question is like this. I'm targeting a company for merger purpose. And I tell the management of the target company that before we merge with your company, you accelerate payment of your expenses or accrual of your expenses. So that way their income will look on the lower side. Once you acquire it, thereafter you expedite revenue recognition. So some orders which have not yet been confirmed and still you are showing it as sales, that is accelerating income. So earlier you were accelerating expenses, after acquisition you are accelerating income. What does it mean now? It means that before acquisition or pre-money it was downward bias, and after acquisition it is upward bias. It's like this.
Okay, sir.
Palak ji has asked relation between ROE and B and R. Can you explain? Yes, sure. So there is a solid relationship between ROE and B and R. I'll tell you. You know, the growth rate we use in the formula of Gordon's model, that growth rate is equal to return on equity multiplied by retention ratio. So suppose return on equity is 20% and suppose retention ratio is 40%. What do I mean by return on equity? Whatever money I have invested in the business, on that money, if I am getting 20% return, that is return on equity. So formula for return on equity is earning available to equity shareholders divided by equity shareholders fund. On the other hand, formula for retention ratio is EPS minus DPS upon EPS. So if you're earning 10 rupees and distributing 6 rupees as dividend, 60% is the payout ratio and 40% is the retention ratio. So return on equity is 20% and retention ratio is 40%. You are earning 20% and out of that you are retaining 40%. So growth rate will be 8%. So in shortcut, people call it as G, and this ROE, they name it as R, and this retention ratio, they probably name it as B. B into R is actually equal to G. That's the relationship, sir. So higher you earn, faster you grow, and more you retain, faster you grow. Right, sir? Okay.
Thank you, sir.
Oh, most welcome. Mohini ji has asked how to prepare for bond valuation. Okay. How to prepare, probably I will answer. Okay, I'll take that. Look, I wanted to answer this at last, but now it has appeared in the sequence. So now I'm answering it. Just a moment. Just a minute. Okay, we have this. Look, first of all, whatever material has been shared to you by various faculties on various matters, so I would like to recommend that first of all you go through that material, because that material is valuable, whether I have shared it or Sumit sir has shared it, or Dhamija ji has shared it, or Mittal sir has shared it, or Priti madam has shared it, or Ajay Garg sir has shared it. All those materials are research material, so you can definitely refer to it. Number two, you should refer to the ICSI material that has been provided to you. Number three, if you want to go into depth of, bond valuation or fixed income securities, you can refer either CA final strategic financial management material. You will find over there questions on bond management, or you can refer CF Institute material, but CF Institute material will be very heavy to handle. So these are the sources to make a preparation. Additionally, I have also prepared some videos, but those are on subscription basis. Those are not available on YouTube. So I'll quickly tell you about that. That can help you in preparation. It's total 28 hours of videos I have recorded. Probably I might have shared you with the link also. That covers case studies, equity valuation, fixed income valuation, and option valuation. And there I have covered in-depth explanation of all the concepts, because that was a recording. So I paused it and then I again recorded it, and editing has been done and post-production work has been done. So in-depth explanation is there. There are many questions. And I keep on talking to candidates also that what they have started asking in examination. So it captures all the latest exam trend also. And definitely in that video, I have discussed how to solve questions on MS Excel, or some centers, they don't make available MS Excel. So how to solve it on Apache OpenOffice, how to solve it on your ordinary calculator. And in video, you can play it at your own speed. 0.5, 0.8, 1, 1.5, 2 times speed. You can pause it, you can solve the question. So effectively you take more than 28 hours, because every time I solve a question, I say pause it here, solve it yourself, and then play it again. So 28 hours of video will take 40 hours of time to watch. So do it yourself style videos this can also be a source of preparation for you. And yes, it's subscription based. It's not available on YouTube for free. You watch it 100%. If you don't find it to be useful, you can take a refund. This can also be one source of preparation among many sources available for preparation. So fixed income security is also covered over here also. Right. Puneet ji is asking, an exam hall will get open office Excel. What is difference between Microsoft Excel and open office? Key functions will be same or different? That's a good question, Puneet ji. So like in Excel, for example, okay, I'll open Excel for that and I'll quickly show you that example. Okay, probably Excel file itself is open in front of you. Let me check that. Yes, it's here. So like if I'm using PV function in Excel, I write rate like 10%, then I put a comma. For number of periods, say I'm saying 5 years. So I'm putting commas as separator. This is MS Excel. But if I do same thing in Apache OpenOffice, then instead of comma, they use semicolon sign. So difference between MS Excel and OpenOffice is here. In Excel, the values are separated by comma. In OpenOffice, values are separated by semicolon. That's the main difference. Otherwise, it is almost same. You know, if I talk about 100% functions of Excel, then Excel is much superior to OpenOffice. But as far as valuation examination is concerned, whatever functions you will have to use, all those functions are available in OpenOffice also. Right, Puneet ji? Yes. Manoj sir is asking, I heard we will get spreadsheet. Yes, sir. You can use MS Excel or OpenOffice. One of the two will be available at the center. Before going to the center, a week before, when you book the slot, visit the center and ask them whatever is available, so that you won't be surprised कि अरे मैं MS Excel के लिए prepared हूँ and they have given me OpenOffice. So visit the center as soon as you book the slot and make it sure that what spreadsheet they will make you available. What about, okay, one more thing, like you can use paper, pen and calculator also. I recommend that even though they will make you available Excel spreadsheet, still I would say that you carry a calculator, because if you are carrying a calculator, it really becomes easy, because some of the calculations are easy to do on calculator rather than to do it on MS Excel. Vignesh ji has posted me a doubt in a personal message. What about European option, sir? Please explain. Sir, if you're asking me difference between European and American option, so European option can be exercised only at the time of expiry. Say I take 3 months call option. So today it is the month of, currently we are in the month of August. I take option for August, September, October. I take October ending option. So what do I do in this case? If it is European option, I can exercise it only in October end, not in between. But in case of American option, it can be exercised on any day till expiry. That is American option. A third type of option also exists, sir, which is actually named as Bermuda option. And Bermuda option is like this. You can exercise it on a series of exercise dates. So if I'm taking 3 months call option, and suppose I have a choice to exercise it on any Monday or finally on expiry date, that is an example of Bermuda option. Okay, Anjum ji has asked me, SWOT analysis is internal, SWOT analysis is external, micro or macro. Look, SWOT analysis itself is not internal or external. Strength and weakness are internal. Opportunities and threats are external. So SWOT analysis includes both internal and external analysis. So internal alone cannot be a choice. External alone cannot be a choice. Micro cannot be a choice because you are talking about opportunities and threats which are there in the economy. So probably I can answer it as macro. Looking at the choices available, the question is little absurd because SWOT analysis is not internal or external. It is both internal and external.
It is exam question.
Okay, so in that case, you will have to choose macro. मतलब जिस तरह का क्वेश्चन है उसमें मैक्रो के अलावा कोई चॉइस नहीं बचता है
क्वेश्चन इस तरह के कम से कम 10 क्वेश्चन आते हैं जिसमें डाउट्स काफी सारे होते हैं, चारों हो सकते हैं इसके ऑप्शंस.
हाँ नहीं सर, इंटरनल और हाँ इंटरनल इसलिए नहीं बोलेंगे क्योंकि इट्स नॉट प्योरली इंटरनल, इट इज इंटरनल एज वेल एज एक्सटर्नल. सो इंटरनल एक्सटर्नल इफ वी रूल आउट देन वी आर लेफ्ट विद माइक्रो एंड मैक्रो. इट इज नॉट माइक्रो बिकॉज आई एम नॉट टॉकिंग. अब वैसे देखा जाए टू सम एक्सटेंट इट इज माइक्रो आल्सो बिकॉज आई एम टॉकिंग अबाउट माय स्ट्रेंथ्स एंड वीकनेसेस. But at the same time, in opportunities and threats, I am talking about the whole economy situation, which is going to affect me. So probably that can be answered as macro. Still, I will say it is an absurd question. But if I would have faced it, I could have marked macro. Right, sir?
Thank you.
Most welcome, sir. So one question from the side of Harvinder Singh, sir. A firm operating profit is 40 lakh and interest expense is 10 lakh. Okay. So EBIT is 40 lakh, interest expense is 10 lakh, the profit before tax is 30 lakh. Cost of equity is 18%, cost of debt is 12%. They have option to raise fund of 100 lakh by way of debt, then profit will increase by 20 lakh. Okay. What is current weighted average cost of capital? What will be weighted average cost of capital after new debt of 100 lakh? And what will be available profit for equity shareholders after raising the fund? Okay, so some informations are missing, but definitely we can find out those information also, not a big deal. So in this situation, what I'll have to do? I'll have to do it like this. I'll start with EBIT, which is 40 lakhs. Then I'll deduct existing interest, which is kind of 10 lakh. So my profit before tax is 30 lakhs, 40 minus 10. Tax rate, was it given? Let me check. You have not given me any tax rate, so I'll assume tax to be 0. In this case, look sir, whatever questions you are posting, I am solving it on the basis of available information. So solving of question is on available information. I do not give you a conceptual correctness guarantee because this is your question and I'm simply solving it. Now I will divide it by profit after tax is this, cost of equity. If I divide profit after tax by cost of equity, then I'll get value of equity. So it is like 30 divided by 18%. This is value of equity. Value of debt. So value of debt can be calculated like this. 10 lakh rupees is interest and 12% you are saying is the interest rate. So amount of debt must be 83.33. So total of debt and equity here will be 163 plus 83, that is 250 lakhs. So to calculate weighted average cost of capital, I'll do it like this. 10%. 10% means simply 10. It should be multiplied by 83.333 plus it's 12%. No, yeah, it's 12%. 12% into 83.333 plus 18% into 166.667 and oh, I'm sorry, I'll have to type it again. So it's like 12 into 83.33 plus 18% cost of equity multiplied by 166.67. Total of weight is 250. So weighted average cost of capital is 16.8. 16%. After new debt, what will be weighted average cost of capital? So apply the same process again, sir. Now you are saying that EVID is increasing by 20 lakhs, so it will become 60. Interest will increase by 100 into 12%. आपने नए डेट का मुझे कॉस्ट नहीं दिया है, so I'm assuming it is existing rate, that is 12%. So 10 plus 12, 22 lakh will be interest. Cost of equity we are assuming to be same. So now the new WACC can be calculated like this. You take 12% multiplied by, oh, this one will become plus 100, no? 183. So you take cost of debt as 12%, multiply it by 183.33 plus cost of equity as 18%, multiplied by 211.11, divided by total of the weight 394.44. So, oh, something has gone wrong. Oh, this is multiplication sign, I'm sorry. So this is 15.21%. Harvinder sir, is that clear?
Sir, I lost the connection.
So when the in the exams it was saying that we are borrowing new funds, means borrowing new funds and existing funds, we have to compound or total of both funds and then calculate.
Yes,
Is it
exactly, exactly. So my existing capital is already there. Now I am borrowing new capital. I cannot make calculation for new capital separately. If they ask me to calculate marginal weighted average cost of capital, then I will ignore existing capital and I'll concentrate only on the new capital which is to be raised. But if they are asking me new weighted average cost of capital, then I'll consider existing as well as new. If they want you to calculate only new one, then they will say what is marginal cost of capital, right?
Thank you, sir. Thank you.
Sir, good morning, sir.
Yeah, who is there?
Sir, I am Chandrasekhar from Bangalore.
Right, sir.
Sir, this is an examination question. In case, in fact, I have also posted in the WhatsApp.
Okay.
We also discussed with the other group. I think what you given is correct. Sir, how to calculate this exam? Same question, sir. No tax rates are given. In fact, we could not solve in the exam.
Okay. So should I repeat it what I already said?
It's okay, sir. Only thing is you said marginal cost. Now, what is the marginal costing? How to
marginal cost will be 12% in this case because the new fund is 100 lakhs and it is 100% from debt. So marginal cost is 12%.
Okay. Thank you, sir.
Yes. Yes.
Sir, how the equity came to 211 from 166?
Okay. So equity is here, sir. Profit after tax divided by cost of equity. Now profit after tax has gone up to 38 lakhs level. So 38 lakh divided by 18% will give you 211.11. 38 divided by 18%. Just like 30 divided by 18%, we got 166. So similarly, 38 divided by this one, just a minute. If you have posted any, okay, all right, great. PPT is not properly visible. I hope it's visible now to everybody, my Excel sheet.
Yes, sir, now it's visible.
Okay. Any other doubt on this question which has been posted by Harbinder Singh, sir?
Sir, and sir, debt you also calculated same as you calculated equity, means interest divided by the rate of debt, means KD.
Exactly. I did it here. Like amount of interest was 10 lakh and rate of interest is 12%. So if I'm giving 10 lakh rupees of interest and interest rate is 12%, so loan amount must have been 83 lakh. 83 lakh into 12% will give me 10 lakh rupees of interest. Right, sir?
Yeah, thank you, sir. So will you, sir, share Excel after the this session?
I can, sir. Not a problem. I can share. No issue.
Yeah, thank you, sir.
Thank you, sir.
Most welcome, sir. Labdi ji is asking me if the coupon rate of the bond is dash yield to maturity. Let's say below yield to maturity. the price of the bond should be below par value. So either it will be above or below. So I think it should be above. If the coupon rate of a bond is above YTM, the price of the bond should be above par value. Let's prove it by taking a small simple example. Suppose we take a 3 years bond which pays 10% coupon. So you'll be getting 100 rupees, and in last year 100 plus 1000 you'll be getting 1100. Now suppose your YTM, right? Your coupon is 10%, that is clear. YTM is suppose 12%. Sorry. YTM is 12%. So I will discount all these cash flows at the rate of 12%. In that case, I will say this is equal to NPV at the rate of 12%, comma, and I'll select this range and see. Now let's read a question posted by Labdhi ma'am. It says that if the coupon rate of a bond, okay, I'll have to change the example. Let's make it 8% example. If it is 8%, so that it will be perfectly fit. Okay. If the coupon rate of a bond is above the yield to maturity, look here, yield to maturity is 8% and coupon rate is 10%. So if the coupon rate of a bond is above yield to maturity, the price of the bond should be above the par value. Look here. It is above the par value, 1051. In exam also, you can quickly create one short example for yourself. You know, if by simply applying the logic, you're not getting what they want to ask, then you can create a small example for yourself and check it. Okay.
Here अगर 12% YTM हो तो सर चेंज हो जाएगा आंसर.
हाँ, अगर सर 12% होगा तो फिर वो वाला ऑप्शन इस MCQ में हमारे पास अवेलेबल ही नहीं हो रहा है. Just a minute. In that case, you know what will happen? Just give me a moment. In that case, it will be below. If the coupon rate of a bond is below YTM, so here coupon rate is 10% and it is below YTM, then the price of the bond should be below par value. So, but you don't have below option. You have a below above below, above. Probably the fourth option must have been none of the above. So that's why, you know, problem will be there. If they give both above and below, both will be correct. So the question will become absurd in that case. So that's why this is a perfect question.
Sir, in enhancement to this question, sir, if the YTM, I'm going to request to escalate the option of YTM with the duration. Means if the YTM is less,
okay,
how much the duration is less
posted
or
this
high?
to me on WhatsApp, na?
Yes.
Okay.
Yes.
Duration. So let's add duration concept also over here. So now I'm deleting this. What is duration? It is the weighted average of the time. So suppose your YTM is currently it is 10%. Let's say, okay. So how do you do it then? You calculate present value of cash flows at the rate of 10%. And number of period is this. PMT I'll skip. So I am calculating present value of cash flows at the rate of 10%. And then I make a sum total of all these values. So if YTM is equal to coupon, bond is quoted at par. You already know this, right? Now let me introduce one more thing over here. Let's call this is T, that is time. And let's say this is the weight to be allotted to the time. What is duration? Duration is weighted average of time, sir. What is duration? Duration is weighted average of time. So I'll take time 1 and multiply it by its weight 90.91. So similarly, I'll copy it down and copy here. So summation of T into WT is 2735 and summation of weight is 1000. So duration in this case will be like this: 2.735 divided by 1000. 2.73 years. 2.735537, right? If YTM increases from 10% to 20%, say, in that case, just look here, duration reduces from 2.73 to 2.70. Higher the YTM, lower the duration. You can observe it yourself. If the YTM is 10%, duration is 10.73. But if the YTM goes up to 20%, duration becomes 2.7. Though the change is just a very slight change for a huge increase in YTM. But yes, when YTM increases, duration reduces. So I'll tell you reason behind it. When YTM increases, you know what happens? You are discounting cash flows at higher rate. So the last year you have a major cash flow. So when you increase discounting rate, last year will be highly affected. Most of the impact will be on the last year because there you have the major cash flow and there it is at the end of the life of the bond. So when you increase YTM, present value of first year reduces as well as present value of last year also reduces. But present value of last year reduces rapidly. It means last year loses its weight and first year comparatively gains the weight. And that's why this duration actually reduces. So this is highly mathematical. This is deep time value of money concept. Still, I explained it once. Don't expect yourself that you will be able to grasp it in a one shot. But yes, at least we have.
Can I discuss, sir, more in this, sir? Can I discuss more in this?
Yeah, sure.
Yeah. Yes, sir. YTM is equivalent to IRR. That is the cost of capital. Means that is expectation.
Expectation of investors. Perfect.
Yeah. Means it is a cost to company.
Right.
Yeah. When it is the, sir, when the cost cost increases, so then the, sir, duration is also increases, sir. Means in the logic, sir, I am just I'm a little bit confused.
Okay, you want to get logic of it? I'll give you.
Yeah. Because, sir, the cost and the, sir, duration, I think it go in the same direction. It should not go in the vice versa direction.
I will tell you, sir. Just give me one moment. So we need to. Okay. So now look here. If I calculate present value of 1000 rupees at the rate of 10%, so at the rate of 10%, this is the time period. Present value is 909.09. Okay. Just a minute. And present value of 1000, which is receivable at the end of 10th year, is as low as 385. Okay. Because here in the first case, you are dividing cash flow by 1 plus r raised to the power 1. And in this case, you are dividing it by 1 plus r raised to the power 10. Okay. Now, if I'm using 20% as the discounting rate, just a minute, please. So observe what changes will occur. Look. So the whole story here is when I increase discounting rate, present value of first year's 1000 rupees reduces by 75 rupees. And present value of 10th year's 1000 rupees reduces by 224 rupees. You will have to focus it here, sir. When discounting rate, that is YTM, increases, present value of first year's cash flow reduces. Present value of last year's or 10th year's cash flow also reduces. but present value of first year reduces slowly, while present value of last year reduces rapidly. Moral of the story, with increase in discounting rate, last year will lose its proportion in the value and first year will gain its proportion in the total value. And what is duration? It is the weighted average of time. This is the time and you are assigning it a weight of present value of cash flow. What is duration? It is weighted average of time. So this is time and you are assigning it a weight of present value of cash flows. When you increase YTM, you know what happens? First year's present value reduces, but last year's present value reduces very rapidly. So last year will lose its weight in the weighted average calculation. Consequently, initial years will gain weight in the weighted average calculation. So you are calculating weighted average of 1, 2, and 3. 3 is losing its weight. 1 is gaining the weight. If you give more weight to 1 and less weight to 3, weighted average will reduce. So that's why with increase in YTM, duration actually reduces.
Yeah, thanks, sir. Thanks.
Okay. Most welcome. Most welcome. So that was quite technical. So I was actually trying to avoid it at first shot. Okay.
In relation to the same answer you gave about my question, sir, can I ask, there is one correlation given when yield increases, price go down and duration go down. Can you answer this question in relation to this correlation?
Yes, definitely. So if YTM increases, then what happens? Number one, bond price reduces.
Yes.
This is acceptable to everybody, I think.
Yes.
And when YTM increases, duration also reduces, right?
Right.
So ultimately, what I can say that when bond price reduces, duration also reduces. When bond price increases, duration also increases. There is no relationship between bond price and duration, but there is relationship between YTM and price, YTM and duration. So X is related to Y, X is influencing Y, X is also influencing Z in the same direction. But it doesn't mean that Y and Z are correlated. Okay. They are correlated to X, and that's why it looks like that they are actually correlated.
Okay.
Right?
Okay, sir. Thank you, sir.
Most welcome. Okay.
So how do we calculate the bottom up beta?
Okay, bottom of beta. All right, all right. Okay, sir. So can you please post it for me? Because let's go.
Sure. Okay, okay.
Let's go with sequence. Can you share the link again? I am not aware. Leena ji was asking. Leena ji, you were asking about which link?
Your recorded sessions, you were saying, no?
Oh, okay. All right. So, all right. I will share. Let's do one thing. I will just, okay, that was the demo video link. Just give me one moment. Probably it must have been posted to any one of you, because usually after the batch I post it so that people are aware about it. Just a minute.
Was it after our batch that you made this, or is what there from before?
Yeah, I made it later.
Okay.
Okay, that's why probably you don't have it.
Correct.
Sir, one question is that, sir.
Sir, my humble request is to just post it, or if it is general question, then you can ask it right now, sir.
Sir, modify duration or Macaulay durations in this we calculate. Then
okay.
What is the meaning of that, and what examination accept?
I asked this question later on, sir. This is sequence.
Okay. All right. You have already posted this question. One of the participants, sir, has already posted. So I'll answer it, sir. Don't worry. I'll definitely answer it. So the madam was asking me about the link. Just a moment. I will give that link. That has the demo link probably. Is it possible for you to copy and paste chat?
Yes, sir.
Okay, so then I'll post it here only. So this is the message usually I drop after the session is over. Okay, but where is the link? Link has not been posted. So I'll post the link once again. Give me a moment. This is the YouTube link, probably. Yeah, this is. We have discussed. Okay. Sorry. Right. So now let's move to the next. The next question here is, can you please explain how to calculate contributory asset charge in excess earning method for valuation of intangible asset? Okay, so usually I don't take this intangible asset part, but probably you are asking about multi-period excess earning model, MEEM. Contributory asset charge means whatever assets have to be deployed in the business for the purpose of production. Like I need land, building, plant, machinery, furniture, fixture, current assets, current liabilities, that is working capital. So I estimate, suppose you are running a business, say you are the owner of a sweet shop in Indore, and suppose that sweet shop is named as Agrawal Sweets. In Indore, actually, there is one very famous sweet shop, and it is named as Agrawal Sweets. So it has such a good and huge brand name. And if somebody asks you to make valuation of the brand name of Agrawal Sweets, so what do? First of all, you calculate yearly earning of Agrawal Sweets, and thereafter you deduct contributory asset charge. So if you want to create a similar sweet shop, then you will have to take a premises on rent. You will have to build furniture, interior designing of the shop has to be done. You need to own a factory where the sweet is actually prepared. So whatever assets are required, suppose 10 crore rupees of investment will be required to create a similar sweet shop. And suppose now cost of gathering 10 crore rupees of fund is 10%. So on 10 crore rupees of fund, 10% cost will be there. So contributory asset charge will be like 1 crore rupees. But actually the profit of Agrawal Sweets is 2.5 crore rupees per year. Minus contributory asset charge is 1 crore. So excess earning is 1.5 crore. Now similarly, you calculate excess earning for many number of future years and then calculate sum of present value of all future excess earnings to arrive at the current fair value of the intangible asset, like goodwill or the brand name, whatever it is. Right, ma'am?
Yes, sir. Thank you. Thank you.
Chandraji is asking, a firm operating profit is 40 lakh. Okay, this question has already been addressed.
It is answered, sir.
Okay, yes. Minuji is asking, sir, please accept request of one of my classmate. Okay, so, okay. Somebody has joined late, na? I have admitted everybody now. Nobody is in the waiting room.
Yeah, yes, sir. Yes, sir.
Okay. What is H model of valuation? Okay, all right. I'll tell you that. Just give me one moment and I'll tell you H model. I have probably some ready material on it. No, not in this file. Give me one moment and I have some ready material on H model. Okay. Third file I'll have to try. Yes, found it. H model, right? You know, I have started taking this H model in some of the recent batches. So earlier I was not teaching this, but so some of you might already be aware about the H model. still I'll quickly tell you what is H model. It is actually for linear decline in growth situation. So this is the question. Suppose a company's current dividend is rupees 10 per share. Growth in dividend for first year, second year, third year and fourth year are respectively 18, 16, 14 and 12. Thereafter, the growth rate will stabilize forever at 12% and cost of equity is 20%. If you try to solve this question with a two-stage dividend discount model, in that case, the solution will look like this. You make a table for 3 years, calculate dividend by applying 18%, 16% and 14% growth rate, calculate present value of all those dividends at the rate of 20%, make a sum total of all those dividends, and thereafter, step number 2, you calculate fourth year's cash flow, then you calculate third year's terminal value. This is not H model. This is two-stage dividend growth model. And then you calculate present value of terminal value also. And finally, you get fair value. So for 3 years, growth rate was variable. So you made a table for 3 years. Fourth year onward, growth rate is constant. So you calculated terminal value at the end of third year and then calculated present value of that terminal value also. And then made a sum total of all those cash flows. This is the two-stage dividend growth model. But the alternative method to solve this is H model. H model can be applied only if there is a linear decline in growth, like 18 to 16, 2% decline, 16 to 14, 2% decline, 14 to 12, 2% decline, and so on. It's like this. So 18, 16, 14, 12, 4 growth rates are there and a linear decline in growth rate is there. Now, if you want to solve this question with H model, it should look like this. The answer has been typed wrong. It is 155. Probably it's 140 plus 15 equal to. So in H model, the formula is like you take dividend for 0 year, which was 10 rupees. Now there are two growth rates. First growth rate was 18% and the last growth rate was 12%. So 18% is named as short-term growth rate because it will not prevail forever. The last one, 12%, is named as long-term growth rate because it will prevail up to infinite years. So you take 0 years dividend multiplied by 1 plus GL, 1 plus long-term growth rate, that is 1.12. And then divided by cost of equity minus long-term growth rate. Then you take 0 years dividend and here it is short-term growth rate 18% minus long-term growth rate 12% divided by cost of equity 20% minus long-term growth rate 12%. And here comes the most important thing, H. What is H? H is half of number of growth rates. H stands for half of number of growth rates. So there are 4 growth rates given in the question, 18, 16, 14 and then 12 forever. So number of growth rates are 4. Make it half, it will become 2. So that's why H here in this formula will become actually 2. And once you put H at this place, thereafter you can easily solve it. And then you can find that the answer is same. You know, if Excel is not available, then solving a question by two-stage growth model is very lengthy. In that case, H model can give you an answer quickly. You can take a picture or screenshot of this particular question with its solution so that later you can analyze it by taking your own time, right? This is H model, linear decline in growth. Okay. Bond duration. In simple terms, what is difference between Macaulay's duration, modified duration, approximate duration, effective duration, money duration? When question asked about the calculate bond duration, what we need to calculate? Okay, all right, great. So I'll again share that Excel file. Wait a moment. This is here. How to calculate duration? We have gone through this. Duration is nothing but weighted average of time. So you take time and then assign it weight. Weight of present value of cash flows at that point of time. And then you calculate the weighted average. You know, in Excel, there is a shortcut formula also for calculation of duration. And you can use that formula also. But that goes with date. That is the issue date, expiry date, etc. This is duration. This 2 point, let's put here 10%. This 2.73 year is duration. It is also named as Macaulay duration. Mr. Macaulay invented this concept, and that's why it is named as Macaulay's duration. So when somebody is asking you duration or Macaulay's duration, it is one and same thing. But if somebody is asking you modified duration, then modified duration is equal to Macaulay's duration divided by 1 plus current yield to maturity. So here, if I want to calculate modified duration, I take duration and divide it by 1 plus 0.10 because current YTM is 10%. Duration divided by 1 plus YTM. So the duration or Macaulay's duration was 2.73 years, while modified duration is 2.4868 years, right? Then one more thing you have asked is effective duration. Now I cannot show you calculation of effective duration. That's a complex mathematics. But let me tell you, in case of plain vanilla bond, people calculate duration. But in case of bonds with embedded option, people calculate duration or effective duration. Bonds with embedded options, I mean call option or put option, callable or puttable bonds. If you want to calculate duration of callable or puttable bonds, it is named as effective duration. This can also be named as approximate duration. Then there is one key rate duration. It is for change in discounting rate for any specific year only. It is for change in discounting rate for any specific year only. You can see while calculating duration, I have used 10% as the discounting rate for first year, for second year, and for third year. But if I change discounting rate only for first year or only for third year, something like this, and then I try to figure out duration, that is named as key rate duration. Calculation of key rate duration and effective duration is a tough task. They won't ask you to calculate it, but definitely they may ask you that what is the meaning of it. So Macaulay's duration is weighted average of time. Modified duration is duration upon 1 plus YTM. Approximate or effective duration is used in case of bonds which are callable or puttable or both. Money duration, we can Google it because this is not a popular terminology. Rather than the popular terminology is key rate duration. Right, sir? Harjit, I hope that answers your question. Option valuation. Are in all three methods of option valuation comes to same binomial, put, call parity and Black-Scholes model? No, sir. Binomial pricing model is used for valuation of American options, while Black-Scholes option pricing model is used for valuation of European option. Now, as far as put call parity is concerned, it is simply that suppose you have calculated value of call option using BSM, Black-Scholes model, and you don't want to do the hard work of calculation of value of put option again. So in put call parity, you keep value of call option and two other inputs, and as a balancing figure, you get value of put option. Binomial is used for American. Black-Scholes is used for European. Put call parity simply says that there is a relationship between value of put option and call option. If you know value of call option, you can calculate value of put option. If you know value of put option, you can calculate value of call option as a balancing figure. Binomial theory for option 2 stage question. It is asked in exam. Put call parity is a European option. I think it is not part of syllabus. How can we know which method to apply for computation of option value? Yes, sir. Actually, they have started asking question on binomial, and that too 3-step binomial tree. I will just quickly show you that what is a 3-step binomial tree. Just give me one moment. I cannot explain it right here, right now, because it's a very lengthy process. But definitely I can just show you that how does it look like. One moment. I have one file on it probably. So this is here. So this is how, the question looks like. The solution of a 3-step binomial tree will look like this. You'll have to create a lengthy tree and then make valuation. Then you'll have to calculate P and 1 minus P using this formula. Then you will have to apply this lengthy value of call option formula like this. And then roll back number 1, roll back number 2, roll back number 3, roll back number 4, roll back number 5, roll back number 6. You keep on doing this, and that is how you finally get the value of the option in this tree. So this is the whole process, sir. And I must tell you, it is very lengthy. I cannot explain it here. But yes, if they ask something like this, then definitely you will have to solve it this way only. There is no other choice. Okay, so the last question was asked by Hardik sir. Is that okay, Hardik ji? Currency and interest rate, concept forward spot rate. F11, F12, F31, too much confusion, interest rate swap and currency swap, how it works, and suggest any easy reading for understanding. Okay, yes, forward rate symbol reading, I can definitely tell you quickly. Look, sir, it's very simple. If I write it like this, F11, I'm highlighting F11, I'm reading what I'm reading. I'm reading doubt posted by Hardik ji, and it is the last paragraph of his doubts. F11, what does it mean? Forward rate of interest, that you will borrow money after 1 year and repay it after 1 year. That is, first year end you will borrow and second year end you will repay. F12, it means you are ready to borrow after 2 years and you'll repay at the end of third year. Borrow at the end of second year, repay at the end of third year. For that, if you enter into a contract right now, if Hardik ji agrees that he will give me a loan of 1 lakh rupees at the end of second year and I'll repay him loan at the end of third year at the rate of 10% per annum, then F12 will become our forward rate of interest. So, there is a connection between forward rate of interest and spot rate of interest. If you calculate geometric mean of forward rates, you actually get spot rate of interest. Or if you don't want accuracy, then if you calculate arithmetic mean of forward rates, then also you get the spot rate. where to read it. Again, CA Final Strategic Financial Management Study Material. It is available at ICAI website. There you will definitely find it, and they do give illustrations also on the same. And as I have already told you that the videos I have prepared also includes this, because I have covered case studies, fixed income and options. Okay, one lengthy question has been posted. Okay, Chandra sir, just give me some time first. Allow me to answer some concept questions, because it looks like a whole lengthy question. We'll have to solve it. It will take some amount of time. So before, let's take some small questions. Which of the following is least affected when the coupon rate changes? Okay, that's a good question Harbinder sir has asked. 20 years 10% coupon, 20 years 0 coupon, 10 years. Look sir, now this is a very good question Harbinder sir has asked. When YTM changes, bond price changes in the opposite direction. If YTM increases by 1% and duration of bond is 5 years, if YTM increases by 1% and duration of bond is 5 years, in that case, bond price will reduce by 5%. But if duration of bond is 10 years, then within 1% increase in bond price, 10% downfall in the, 1% increase in YTM, 10% downfall in the bond price will occur. Okay, I will type it here for your convenience. Look here. Suppose duration is 4, suppose duration is 6, and suppose YTM increases by 1%, then bond price reduces by 4% in this case and 6% in this case. Higher the duration, higher the price fluctuation, right? Higher the duration, higher the price fluctuation. So look here, 20 years bond, whether it is 10% or it is 0%, it will have a high duration. And 10 years bond, whether it is 6% or 0%, it will have a low duration. Now, out of 6% coupon bond and 0% coupon bond, 6% coupon bond will have lower duration. Higher the coupon, lower the duration. So I'll give you two important points here. Longer maturity equal to higher duration, and higher coupon is equal to lower duration. So first of all, question is asking me least affected, यानी जिसका ड्यूरेशन सबसे कम हो वो लीस्ट अफेक्ट होगा. 20 इयर्स वाले का ड्यूरेशन तो ज्यादा होना है, उसको छोड़ देते हैं. 10 इयर्स वाले में सबसे कम ड्यूरेशन किसका होगा? 6% कूपन बॉन्ड का, और इसीलिए 10 years 6% coupon bond will have least duration, and that's why it will be least affected.
So the question asks about the coupon rate when the rate is changed, not the YTM.
Yes, it is coupon rate I'm talking. Higher the coupon, lower the duration. This is the fact. अभी उसको प्रूव करने जाएंगे तो वो प्रूव हो जाता है, लेकिन आप बस थोड़ा सा वो, it's a lengthy process, but it can be proved. For a zero coupon bond, okay, let me tell you this way. आप देखिए यहाँ पे, let me put it this way. This example I took, right? And here the duration was 2.73 years. Suppose it is a zero coupon bond and it is 0, 0 and 1354. Lump sum amount will be paid. Now look here, the duration is 3 years. तो जैसे ही मैंने कूपन को 10% से रिड्यूस करके 0 करा, वैसे ही ड्यूरेशन 2.73 से बढ़ के 3 हो गया. Lower the coupon, higher the duration. For zero coupon bond, duration will be equal to maturity. देखिए वापस से मैं रिपीट करता हूं, ये 10% coupon bond था जिसका duration 2.73 था. If I reduce it to be a zero coupon bond, no coupon rate, then duration actually rises. Lower the coupon, higher the duration. Right, sir?
Okay, sir.
So that's why 10 years, 6% is the correct answer. Bhavya ji is asking, how do we calculate IRR on Excel? So that's very simple. IRR on Excel is like, say you are buying something for 1,000 rupees and you will be getting 500 rupees at first, second and third year. So equal to IRR, bracket open, select the whole range, bracket close, press enter, 23% is IRR. What I did is very simple. Okay, is it clear, Bhavya ji? Bhavya ji, I'm sorry, I couldn't read the name properly. Prabhakar Rao sir is asking bottom of beta. Okay, so the process to calculate bottom of beta, give me one moment.
Sir, also.
Yeah.
Sir, what is exactly bottom of beta and unlevered and levered? Sir, what is exact conceptually? The same question.
Yeah, sure. I'll tell you. The concept of bottom of beta is like this. You know, suppose my company is unlisted. So beta can be calculated only for a listed company and not for unlisted company. Because beta calculation is based on change in share price with respect to change in Sensex or Nifty. Change in share price, for that your share must be listed, right? So you cannot directly calculate beta for unlisted company. But if my company is unlisted and I need beta, what do? I look for a comparable listed company. So my company is cement company, which is unlisted. I look for a cement company, which is listed. I calculate beta for comparable listed company. So whatever is their beta, I can assume that is also my beta. But there may be a problem that the comparable company may have a higher debt equity ratio and my company may have a lower debt equity ratio. Beta represents total risk, whether it is business risk or financial risk. Beta is the indicator of risk, sir. So whether it is business risk or it is financial risk, beta indicates both simultaneously, right? Now my business is cement manufacturing. Their business is also cement manufacturing. So I can take their beta as my beta, but they have higher level of loan. I have lower level of loan. Or my company is unlevered. Say my company is unlevered and their company, unlevered means zero debt. And their company is levered. It means they have borrowed money. I cannot use their beta as it is. I'll put their beta here at the place of beta L. And then I'll put their debt equity ratio of that listed company at the place of debt equity ratio. And then tax rate also I'll put. And as a balancing figure, I'll be able to calculate beta U. If the same debt equity ratio with industry, we have to bottom up, or we can use India beta directly. No. Not only same industry, but also I'll look for a comparable company. I'll look for a comparable company. Like cement industry, I cannot take. Better I will take a comparable company which is similar to size, which is similar in size also. So I'll take comparable companies beta, I'll put it here, I'll put debt equity ratio of that comparable company over here, and then I'll be able to find out unlevered beta, because say my company is unlevered. So this is bottom up beta approach is very simple. Find a comparable company which is listed, calculate its beta, that is your beta, but before accepting it, adjust it for the level of loan. This is called pure play technique or bottom up beta approach. Right, sir? Okay. Now the next question is, That is okay. Chandraji, you're asking the same question. You can solve this question by applying this formula, sir. Beta L is equal to beta U, right? You will be able to do it.
Thank you, sir.
Hardik ji is asking, sir, in the tree you took interest as continuous compounding. Is it taken when PA is not given? Per annum is not given. No, actually all the rates are per annum. You know, in binomial tree, you can take either continuously compounded interest rate, or you can take discrete compounding, or even I am saying you can take simple interest rate also, because that doesn't make a big difference in your answer. So rather than using the continuous compounding rate, you can also use discrete compounding rate or simple interest rate in a binomial tree. That's not a big deal. That's your choice. That doesn't make a big difference on your answer. Okay, so one big lengthy question is there. Let's do one thing. Two people have posted this question. So you just give it to me, and then with a peace of mind, I will read it and solve it. And later I can get back to you. Because sometimes, you know, these questions are from memory of some people and they don't give full information. The question remains incomplete sometimes. So you have to add bits and pieces to make it a complete question. So you'll have to give me time. I'll just, you can just post it to me, Ashraf sir, you can just post it to me on WhatsApp, and then I'll solve it and then I'll get back to you. Okay, now one MCQ is there. XYZ Limited issued a bond having face value of ₹1,000, 4 years to maturity at ₹900. The bond carrying a coupon rate of 15%. Okay. Assuming that the current reinvestment rate is 16%. The realized yield, realized yield to maturity, really, if they are asking it, Hardik ji, is it the examination question or is it a textbook question? Are you here, Hardik ji? Okay, someone posted. Look, this is realized yield to maturity. I can definitely tell you, but again, I must tell you it's mathematical. Okay, I will try to answer this. This is the question. So the question looks like this: ₹1,000 is face value. Current market price is 900. Company will give you 15% coupon. Reinvestment rate is 16%. So in this case, this is a 4 years maturity bond, and you will be getting amount equal to 150, 150, 150, and 1150. And question is saying, see, the question is about RYTM. It's not about YTM. You know, calculating YTM is simple, but it is asking RYTM. What is realized yield to maturity? First of all, I'll tell you that. What happens, suppose I invest in a bond where the yield to maturity is 15%. I invest in a bond where the yield to maturity is 15%. So I'm assured कि मैंने 4 साल का bond लिया है. So for next 4 years, I'll be getting 15% return. So on my investment, return is kind of assured. But the coupon amount I'll be receiving every year from this investment, I'll have cash in hand. Like first year, I'll have 150 rupees in hand. What to do with this amount? So I'll invest it somewhere else. Now I will have to invest it at the rate prevailing at the end of first year. That is named as reinvestment rate. This reinvestment rate may be equal to YTM. It may be less than YTM. It may be more than YTM also. यानी जिधर पैसा लगाया वहां तो assured return है, और उससे जो कमाई होगी उसको जब मैं लगाने जाऊंगा वहां जो रिटर्न मिलेगा, that is reinvestment rate. So now I am considering my YTM plus my reinvestment rate, and together what I am getting, that is realized yield to maturity. So YTM is return on your original investment, and then I consider return on reinvestment also till the end of maturity of bond, and together whatever I realize is named as RYT. So for this, I'll have to calculate future value of cash flows at the reinvestment rate, which is given as 16% in the question. And here I apply the future value formula at the rate of 16%. Number of periods that I'll have to show. Future value at the rate of 16%. अब देखिए number of periods का कैसा होगा? At the end of first year, if I am reinvesting, then 4 minus 1, that is for 3 years I am reinvesting. First year end to fourth year end is 3 years, right? And then PV. Yes. Okay. And now similarly, I'll copy it down. So my intermediate cash flows, I'm reinvesting 150, I'll invest, and fourth year I'll get 234, 150, fourth year I'll get 201, 150, fourth year I'll get 174, 150, it is already at fourth year, so no reinvestment benefit is there. I make a sum total of all these amounts, and you know the question is saying bond is available in the market at rupees 900. So by spending 900, you can buy the bond. Now, if you want to calculate realized yield to maturity, it will be simply the rate formula, RATE, rate formula. So number of periods are 4. There is no PMT. So present value is 900. Future value is 1759. And here I get 18.25%. This is realized yield to maturity. This is how I calculate RYTM. First, I calculate future value of all available cash flows. And then I take these two figures. I'll make it red font. See, if I make reinvestment of all my inflows, then I'll have only 2 cash flows, one initial outflow and one inflow at the end of fourth year, because whatever I received at first, second, third year, I reinvested it. So initially I'll invest 900, at the end I'll get 1759. My realized yield to maturity is 18.25%. Answer is not given, option 16, 17. Sir, in that case, I'll say question is wrong, because you are saying that currently the bond is available for 900, na? Issued a bond having face value of 1000 with maturity of 4 years at 900, bond getting assuming the current reinvestment. No, in that case, 18.25, see, this is one of the choices, na? 18.25. 16.77 is not a choice. 18.25, see, we are getting 18.25 and it is one of the available choice. 16.77 तो sir choice ही नहीं है, right? Bajrang sir, probably your question has automatically been answered. That bottom of beta L is equal to beta U multiplied by 1 plus debt equity ratio, 1 plus debt equity ratio into 1 minus tax rate. You apply that formula and your question can be easily solved. Palak ji is asking if same debt equity ratio with industry we have to bottom up, or we can, okay, I have already answered it. How to calculate FCFF from cash flow from operations? Cash flow from operations, you want to say, what is cash flow from operations? After making working capital adjustment, but before making adjustment for income tax. What do you mean by cash flow from operations? Ankit ji?
Sir, direct EBIT is given. And sir, it was in the question in the exam that FCFE you have to calculate.
EBIT was given and
yeah.
FCFE
FCFE or FCFF we have to calculate.
Okay, that's easy. That's easy. In that case, you start with EBIT, and if suppose you want
Sir,
to,
no other information was given, sir. No other means no interest and no taxation. Means nothing is, no information is given, sir.
okay, say they are saying EBIT is 100 and calculate FCFE, and nothing else is given.
Yeah, rate was given. Means I was not remembered fully, but
Okay.
I have given one attempt. Means no depreciation, oh sorry, no interest and tax information is given, sir. If you correlate anything, sir, otherwise means I know that formula which you have discussed in your classes or in the beginning of this session. I remember or I know this, sir.
Okay.
But this I am not able to correlate.
नहीं सर, ये तो इतनी इंफॉर्मेशन से नहीं सॉल्व होगा.
नहीं सर, कोई ऐसा फॉर्मूला नहीं है कि सीधा कैश FCFF हम मींस कैश फ्रॉम ऑपरेशन से कर सकते हैं, कुछ ऐसा कोई फॉर्मूला नहीं है.
कैश फ्रॉम ऑपरेशन से एक अलग टर्मिनोलॉजी हो गई अंकित जी. कैश फ्रॉम ऑपरेशन इज लाइक दैट व्हेन यू प्रिपेयर कैश फ्लो स्टेटमेंट विद इनडायरेक्ट मेथड, then you start with profit before tax, and then you add back non-cash expenses, and then you make working capital adjustment. So that is probably cash flow from operations.
Okay, sir. I will find.
So, sorry, unmute yourself.
Yeah, so, I will try to find, sir, the purely remember.
Yes.
You can ignore, sir. You can.
Yeah. Thank you. I'll need more information. Thank you.
Yeah.
Okay. Chandra sir is asking, can any one of the participants save full chat and post on WhatsApp in RVO1 group? Okay, just do that. Okay. Looks like हमारा एक राउंड डाउट्स का यहाँ पे पूरा खत्म हो गया, because all the doubts which have been posted have been solved. So too many doubts were there, but yes, I tried to make justice to all of the doubts. So I will just quickly, I'll repeat it for you. You know, if you're good at finance, then it's fantastic. But if you come from a law background, and then I will say, then you can watch these videos for which I have already told you, where I have gone very systematically. I have given you a demo link also. You can note down number of my staff, and he can give you more information on this, or you can take a screenshot of this one. Some of the informations have already been posted over here, and my staff has a number of 98279 10983, because many people keep on asking me. I have been doing this for last 1.5 years, and they say, why don't you write a book, or why don't you prepare a video? See, writing a book is a very, very lengthy job. So I prepared these videos so that those who come from non-finance background especially, they will be highly benefited. Those who are from finance background and very good at finance, they don't need any such help. They can simply, study themselves. There is no need for any further support. So yes, most welcome, sir.
Sir, I think one question is from arbitration pricing theory, APT.
Okay. Arbitrage. Okay. Some link has been posted. Let me just check that. Is it the right study material? Yes, sir. This is the study material, financial policy. Yes. This is the right study material. Arbitrage pricing theory question, sir. So have you posted it?
No, sir, I am not reminded.
Okay. Arbitrage pricing theory is just like, just like we have CAPM. Similarly, there is a model which is named as factor valuation model. अभी वो factor valuation model, it says that कि जरूरी नहीं है कि बीटा इज द ओनली फैक्टर. आप अपनी इकोनॉमी का एनालिसिस करेंगे और आप अपने खुद के 4 फैक्टर ऐसे निकालेंगे जिस पर आपकी एक्सपेक्टेशन बेस्ड होगी, और उसी के ऊपर आर्बिट्रेज प्राइसिंग थ्योरी बेस्ड होती है कि अगर एक शेयर इस डिस्काउंटिंग रेट से डिस्काउंट करके फेयर वैल्यू आपने निकाली, और अगर मार्केट प्राइस उससे कम है तो अंडर वैल्यूड होके आप आर्बिट्रेज कर सकते हैं, और सिमिलरली ओवर वैल्यूड है तो भी आप आर्बिट्रेज कर सकते हैं. दैट इज आर्बिट्रेज प्राइसिंग थ्योरी.
Okay, sir.
Meenu ji is asking it's not 18.25. So Meenu ji, have you got 1759 figure?
Sir, in derivative valuation,
Yes, sir.
How we calculate the Black and Scholes and binomial and Briggs nutrition approach? One question is also there.
Okay. I come to that. Let me first answer Meenu ji's question. Meenu ji, have you got this 1759 na?
Yes, sir. Yes, sir.
And this 1759 is there, and then you have to apply this rate formula. Just make it sure that 900 is with a minus sign.
Yes, sir.
So if 900 is with a minus sign and 1759.97 you put, and don't put it at the place of TMT, right? NPER is 4, then skip TMT by putting 2 commas.
Yes, sir.
And then for PV, it is simply click minus 900.
Correct.
I'm sorry, I'll do it again. So for PV, simply click this formula 900 and then comma, and for FP, click 1759 figure and press enter. Okay, you're getting 18% na? So do control
Yes,
1.
sir.
Do control 1. And choose number formatting up to 2 decimal points. A percentage formatting up to 2 decimal points.
Okay, okay.
Right? It is rounded off.
Yes, sir. Yes, sir. Yes, sir. Thank you, sir. Thank you.
Sir, this 234, we need to cumulate the expected returns, no, sir?
Yeah, 234 is calculated as per reinvestment rate given in the question. Your original coupon rate is 15%, but 150 rupees coupon when you receive, you will be able to reinvest it at the rate of 16%. That has been directed by question, and it is for 3 years, sir. First year end, if you reinvest up to 4th year end, the first reinvestment is for 3 years. The second reinvestment is for 2 years, and the third reinvestment is for 1 year.
Thank you, sir.
Yes. Okay, so I was posting you the phone number of my staff. Na? It is here 98279-10983. He's Ajmer Singh Chauhan for inquiry on valuation video subscription. He'll give you full details. It is there in the chat box. My number you already have. In case if you don't have, it is 98. It is, you must be having na. So I am in the WhatsApp group, so my number is already there. All right then, everybody. Wish you all the best. आप फर्स्ट अटेम्प्ट में आप जो भी आप पहला अटेम्प्ट आप फेस करने वाले हैं, I wish you clear the exam over there. And this is not the short journey. Even if you clear the examination and you become a registered valuer and you start getting the assignment and you need any of my help, just feel free to connect with me. If you feel like the assignment is very complicated, then we can work together for it. And you know, after doing 2-3 assignments like this, thereafter you can go ahead at your own.
Thank you, sir.
Right.
Thank you, sir. Thank you so much.
Thank you so much, sir.
Welcome.
Thank you, sir.
Right, Chandra sir. Bye-bye.
Thank you, sir.
Okay then, bye-bye.